Okay, thank you very much, everyone. So I'm sorry to keep you from the Nick Clegg, Nigel Farage debate, which is going on, but luckily for you, I'm a urbane and good-looking like Nick Clegg, and I call it like it is, like Nigel Farage. So you're going to have the best of both worlds here today. What I thought I'd do today is really, I was asked to come and give a talk about our experiences, and so I'm going to tell you the story of a company called Scansafe, which I founded initially in 1999. It was like a week before the end of the year, dotcom days. And that transition of that company, which started in what we used to call back then as B2C and online advertising, completely nothing to do with how it ended. That transition over the course of 10 years, where the company grew and eventually was sold to Cisco in 2009. I then became general manager at Cisco. So I want to take you through that story, and I think it's very important to kind of draw any lessons from that by understanding where we came from and how we got to where we got to. So I'm the founder of Scansafe, but also really a co-founder. I started the business with my brother, so anything I say applies to us both. So let's start at the beginning, rewind the clock back to 1999. The company was called MailRound. Now, just as a small aside, I would urge you to look out for all these different logos. So you'll see this is the logo we ended up with, very sort of professional looking tech logo. That circle thing is how we started. So keep tracking it because you'll see like about 20 different variations over the years. In 2000, I'd left INSEAD in 97 and started a business in the UK. And then all my friends were joining dotcoms. Everyone was looking for a dotcom, pet food online or hats online or underwear online or whatever it was. And so I had my idea, which was to put advertising into emails. And this was one of I mocked up a PowerPoint in 1999 of a Coca-Cola brand. And we were going to sell advertising in person-to-person email. Back then, even a crappy idea like that got funded. So I went to my brother and I said, look, we've got to do it. He was working at a private equity firm and was bored there. And we decided that we were going to launch it, fund it, do it, be dotcom millionaires. So we started about a week before, as I said, the millennium. We put a little bit of money ourselves. We knew how to give good PowerPoint, write a good deck. We've been to business school. We wrote business plans and forecasts and management teams and barriers to entry. And we did everything that we needed to do because we knew how to do that at least. And we got started. The company back then was called MailRound. We hired a tech guy. So we were looking for someone who could write software because I couldn't. And I remember that I had a friend from university who knew something about laptops. So I called him up and he said, oh, I'm sorry about that. I've just joined this company called Last Minute. There's a guy called Brent here and I'm number 3 at this Last Minute, so I can't join you. But I've got a friend of mine from the BBC who I work with. He's brilliant. Why don't you hire him or meet with him? So we hired a guy called John Edwards, who's still CTO with us in our current company. So there's a bit of good luck that we met the right guy, a really great software architect who joined us, wanted to get out of the BBC at that time. Everyone was trying to escape. And we hired him, and he helped draw up this plan. He said the software was going to be like 2K, and it was going to take like 2 minutes to download, and it would take 2 months to build, something like that. None of that was true at all, and it all took a lot longer and a lot more complicated than this initial diagram. Fortuitously, we met episode 1, which was a well-known VC at the time. And we met with them at Claridge's, had breakfast there. They said, yeah, we like your style. We want to invest in you. How much are you looking to raise? I think, if I remember correctly, we raised $5 million from them. But just small anecdote, I remember going to see them and we built this spreadsheet about we were going to make 3 cents from every person per day, and if we had 50,000 people, we multiplied all the Excel cells together and you get some big number. And then they said, oh yes, that's great, but we don't want 50,000 people, we want people who think big. We want like 20 million people. We're like, okay, no problem. So we added a few more zeros, and the numbers obviously, so we thought we were being, sort of really bullish anyway, but they just said, no, more eyeballs, more eyeballs. So that was then. Now it's very different, but back then, people were just, drinking the Kool-Aid. So anyway, to cut a long story short, they invested in us. That is a picture of our first office. It was a serviced office in Farringdon. We kind of got the team together. There were 4 of us. We were all like in our 20s, and we were all feeling very energetic. We were in a startup, dotcom. We were all going to be millionaires. So just to show you what we really look like, you'll notice the second logo, crappy kind of dot-com-y logo. That's me and my brother when I was still kind of young-ish. It's like in 2000, people did this stuff all the time. Dot-com, sort of fluff pieces about how you're going to, and you were called dot-com as well, because that used to add value to your business if you called yourself a dot-com. So we did all that kind of stuff. We really worked hard at it. We were going to do these things called stamps. We called them stamps. They were going to be basically adverts that were going to go into your email. And I wish I had carried on with that business because we probably made a fortune in online advertising. It was quite innovative at the time. So we were busy sort of building up our customer base. We got, I think, something like 200,000 downloads of our little software client, which should be here somewhere, which used to insert these ads. So we were selling basically advertising to advertisers. Meanwhile, in the US, a company called Epidemic Marketing, terrible name, also raised, I think it says here, $7.6 million they raised at the same time for a fairly similar idea. But those guys decided they were all going to do an advert on the Super Bowl. So they burnt through $1.6 million of their funding on one ad at the Super Bowl. And of course, everyone's gone off to get beer at the Super Bowl, and no one saw the ad, and no one certainly downloaded their software, and they all went bust. But that's the kind of thing that went on at the time, whereas we were like kind of good Jewish boys, and we didn't really want to spend $1.6 million on an advert. It sounded too much to us, so we were kind of watching our pennies, but that meant that we had some money, whereas our competitors, for example, all went bust. So that's kind of stuff that we were living through at the time. And you can see, even if some of you will be able to see related stories from 2000, pets.com, obviously pet store's gone bust, these guys are going bust, so everything was going terrible at that time. So we realized that we couldn't carry on like this. Our business really wasn't going to progress. We weren't going to get to where we wanted to go. So we decided we're going to morph a little bit. Instead of selling advertising and emails, we were going to sell branded letterheads to companies. Exactly the same technology, but instead of doing an advert, we were going to send a letterhead. So if you're Shell, you could sell, when you're sending out your emails, you could have your corporate offices and your contact us and your about us and pictures of your oil wells or whatever it was on the right-hand side. So we kind of morphing. The idea here is that we've now gone from a B2C proposition to a B2B. So we're selling the same technology, but now to corporates, because we thought we could make more money that way. And we actually built, we called it Audience Mail, and we built quite a successful little business selling to corporates. So you can see now we've moved across a little bit and started selling to enterprises. Some of our customers there on the right. But 2001 was a bad time. Those friendly guys at episode 1 who told us to add more zeros to our spreadsheet, they knocked on the door one day and said we'd like our money back, because out of that 5 million, we still had, I don't know, like 4.2 million still in the bank because we were careful with it. And they looked throughout their whole portfolio to see who still had any cash, and they would go and knock on the door and say, give it back to us. Because they had, the message came down from JP Morgan Chase, we're out of the internet business. Internet's rubbish, you can't make any money in the internet, we want out of all our investments. So they looked through every single one of their portfolio companies and wanted to get the cash back. So we got a call, we had the sit down, we went to their offices, they brought their lawyers and the company secretary and a bunch of other people, all to scare us into giving them the money back. But we said no. So we went to the pub, it's called the One Ton, and we said, look guys, to the kind of core founding team, they want their money back, but they're not going to get it because we weren't that green. Even though we were like 29, 25, we realized they made an equity investment and not a debt investment, and they're not going to have it back. But obviously, we want to get them off our backs. We want to get them out of the business. We don't want all that preference to sit above us. We never thought we'd ever make any money with $10 million of preference above us. So we thought, what we'll do is we'll buy these guys out, but that means that we have to tighten our belts, we're going to have to get rid of some people, we're going to have to go back to basics, scratch around for a while, try and make this work. So we had that meeting and we decided that that's exactly what we were going to do. So we basically made them an offer. Just to cut long story short, we bought them out for, I think, if I remember correctly, about 8 cents on the dollar. So they put in 5 million, and we gave them back like $200,000 or whatever it was, and got rid of them, which was, by the way, just as an aside, when we later sold the business for 200 million, we wrote to them, tell them what it would have been worth had they have kept it. We obviously didn't like them very much, but so we were kind of in that kind of bootstrap mode. But you have to understand the environment you're in. At the time, no one thought the internet was going to do anything. There were obviously some technology companies that were doing well, but after the dot-com crash, the environment it was very different from certainly what it is now. And so we had a bunch of us. We were all very young and enthusiastic and hungry and ambitious. And we had some good developers on the team, and we were looking for new projects that we could do to try and make some money from this business that we still had. We still thought there was something there. And I called one of my friends from INSEAD who was working at Bain Management Consultants at the time, and she came over and gave us a talk about looking for adjacencies. This is a new word that we'd learnt. Adjacencies to our current business. So we did this, basically a PowerPoint for our own benefit, of looking for new, different things, technologies that we could do, new ideas that we could do. And there was, if you look, there's 5 products here. One was Chatmail, which was basically putting instant messaging chat into the email. Don't ask me why you'd want to do that. One was scanning instant chat. It was called chat then, instant messaging, so for viruses, etc. One was scanning web traffic, which we went on to do. That became Scansafe. Some more ideas about zipping email, etc., etc. So we were looking for new technologies that we can make work. We came up with basically web scanning, and these are some excerpts of emails that Roy and I, my brother and I, were sending to each other as we were sort of discussing it. We're saying corporate customers have a requirement, this is commercially viable. We're kind of finding out that this potentially we've got something here that might be worth us investing behind. This is an email that we wrote to each other, a thread that we wrote. He's writing to me, internet security market's a good one. I'm like, WebScan's got legs as a standalone service. My views go full steam ahead. Yes, we could get plenty of customers. Gem of a company. Need to consider the US. So already, like in 2003, we're thinking about the US, because if you're in techs like the Beatles, you've got to break the US. If you're not in the US, you're nowhere. Things have changed now with Skype and King.com and other companies, but back then, certainly, you had to be in the US. So we decided to start a new product name. We called it Scansafe, because that was the only domain name that was available relating to scanning and security, which we registered back then. You can see a new logo. And that was really a product. It was a product within our company. So we kept the company selling what we were doing, but we developed this new product. We got our software guys to develop a new product and start selling that. Scansafe launches in 2004. So just so you understand what we were doing, we were taking web traffic from companies' laptops and desktops, routing it to our data centers, basically our cloud infrastructure. And there we were doing a bunch of different things like scanning for viruses, scanning for pornography, scanning for spyware and other malicious programs in that traffic, and protecting that web traffic. At the time, everyone was very concerned about email viruses. There was the famous Cornucova virus and the Melissa virus and a bunch of other sort of viruses that were spreading on email, but no one's really focused on web. And so we were using our technology and our knowledge of taking HTTP traffic and processing HTTP traffic to do this virus scanning. So we launched the business we launched the product in 2004, still under the MailRound business name. It's called Scansafe. It was a product, produced a nice data sheet. Got some excerpts of an email here. So Roy's sending to me, I met with Chris Mitchell, head of IT at Morse. This is like our second meeting pitching this thing. They thought everybody will have to have this protection. Overall, very positive, big customer. They saw the demand, they want to have it, et cetera, et cetera. a month later, they faxed the paperwork, we've got an order, we've got some revenues, we've actually got an order coming in. And you can see what happened from there. So in 2004, this green line really, we measure we used to measure everything by number of seats. It's like number of employees, number of desktops that we're protecting. In January, we had like one customer. February, the same. March, sold another 50-seat customer, another 100-seat customer. And then obviously things starting to move. So we're by kind of summer of 2004, we're like, hold on, this product that we've got on the side here that we've invested behind, it's starting to really take off. Like we're seeing like it's a real hockey stick, like it's not even a made up one. This one really is actual and for real. So we're starting, it's still not a very significant amount of money, but you can see that there's some demand there, and we're not obviously marketing globally, etc. So we're starting to get quite enthused. 2005, we decided we're going to back this thing. We're going to change the whole company. So we stopped calling mail round, and called it Scansafe, which was actually the product name. We did what is known as a Delaware flip-up, which means that you basically take your UK limited company and form a Delaware company in the US, which American investors are very keen about. So they want everything to be done under US law. We did something called the Delaware flip-up, became an American company, took some financing from Benchmark Capital. We grew from about 10 employees to about 40, moved in some offices in Holborn. Those are offices that we set up in the US. And now we're starting to sell to bigger customers. So before we were selling to kind of 50-man companies. Now we're selling to Rothschilds, Condé Nast, Bacardi, etc. And you can see the old logo there. So you see the transition. So 2005, we're really starting to feel really bullish. Like, we've now got some money, we've got a product, everything's going great, we need to scale. 2006 was the year where we, really building our credibility, we become a little bit more professional. We start going to these trade shows. Instead of having like a little booth, we've got an actual stand and we're doing events. We've got AT&T as a partner selling to US businesses. I mean, we did amazing business, for example, in Japan. We've never been to Japan, don't have anything translated in Japanese, but AT&T is very, very strong in Japan. They were one of our partners in the US. Their Japanese arm started selling Scansafe, and we had great penetration to Japanese corporates with our services just out of the UK, all via AT&T and then back over to Japan. Postini is an interesting company, was one of our partners. They eventually got bought by Google, which is another quite interesting story, and how that affected us when someone like Google buys one of your very close partners. What does that mean for your business? And so we were selling to bigger customers, working with bigger partners, becoming a lot more professional. We needed customer services, we needed operations teams, we were all scaling the business. This guy here is invested in our business, and he was the one who said those charming things about us. We then got into the Gartner quadrant. I don't know, some of you probably will not be familiar with Gartner, but they're sort of the most respected analyst firm, and when they publish a quadrant on your sector, it's very, very important that you are up and to the right in this quadrant here, which is what they call the leader quadrant. And if you're in that, you basically buy loads of advertising, tell the whole world that you're a leader in whatever the quadrant is. This was the web security quadrant, but you start off basically being a cool vendor, which we were, and then you become a visionary, so you're somewhere over here, then you become a challenger as you're getting bigger, and then hopefully you make it up into the leaders quadrant. And you certainly don't want to be these guys down here who are niche players with no ability to execute, apparently, according to Gartner. So we were starting to appear on this quadrant, and by appearing in the Gartner Magic Quadrant, it's called, great marketing, it means that they're telling their customers about you, and a lot of customers like Exxon or GE will go and call their analyst at Gartner and say, we're looking at web security, who do you recommend we talk to? They say, well, the leaders are Blueco or Secure Computing, you should buy from them, they're fantastic, they've got vision, they've got great products. So that's how you get established in the business, and you can see that Scansafe is there. Like we're a little dot, so we're starting to appear amongst these big boys, Symantec, Message Labs you'll see here. That's the guy who's coming to speak to you next week, so you can ask him all about it. and a bunch of other well-known businesses. So we're selling to bigger customers. We are appearing on the radar. We've got bigger partners. We are now like 120 people, something like that. So you can see the transition, hopefully, of how our business grew. We started as a B2C business. We changed it to a B2B business. We changed from advertising to security. And so complete transformation from the very initial sort of business that was funded. This shows you our revenues during this period from 2000 to 2004, kind of got up to about $500,000 of revenues. So not really very significant. That's like size of a small news agent, basically. For 5 years we were doing that. And the reason I put this chart up, and I'm probably most proud of this chart, of all the charts and all the decks, is because we stuck at it. And if you stick at it, my message to you basically is if you stick at it, you know what you're doing, eventually it comes good. Because that's what it looks like. Those 5 years that I just showed you are down there. They don't even register anymore. So once that hockey stick started, we eventually got to a business which was, when we sold at run rate, $26 million of run rate revenues, and obviously growing at whatever it was, 50, 75% a year. So who knows where we would be today. So hopefully that demonstrates those kind of 10 years and how it's a sort of story of two halves. Some of you like to know numbers, so I've given you this chart. You can see exactly the pre-money valuations of our business. Not many people share this kind of information. So in the beginning, we raised £200,000 from angels, then 4.8 million from Chase, remember them? Then we bought back Chase at 0.5, and obviously our valuation went down. Message Labs gave us some money. That's the guys coming next week. Then Balderton at this valuation. Then Scale. Then finally we took another $10 million from Montague, and then eventually exited at 183 in 2009. So in terms of the exit process, everyone loves to focus on the exit and how does the exit and the money and the exit and the money and the exit. So now I'm giving you some money and exit time. We gave it a name, Project Travolta, because Travolta was disco and disco was Cisco. Which is a lot better than what Cisco called it, because they called us St. Andrews. And you'll see here, I'll show you, I'll flip to it. This is the term sheet that we got from them. You see Project St. Andrews, because it starts with an S. That's how they work. They called us St. Andrews. We called them Travolta, because we thought, we used to be investment bankers, so we like to give code names to make ourselves feel important. Anyway, the story of how we sold to them. So I remember distinctly in 2005. Now, if you remember that, if you've been paying attention, you'll see 2005, we're just starting to get that momentum. People are starting to know who we are. I get a call from Cisco Corp Dev. Hey, Eldar, we've heard great things about you. We really like to connect and talk to you and this and that and whatever. And I kind of put my feet up on the desk and I heard it on voicemail, like, they're coming to buy us, they're coming to buy us. And so that was like 4 years before they eventually bought us. But what these corp dev departments do is they scan the marketplace. They're looking in advance, looking at these younger companies. They don't want to buy you, but they just want to keep tabs on you. So they've got that relationship. So when they get the call, hey, what are we doing about security? We've got nothing in security. Don't worry, we know this company. We'll pick them up. So that's how they do it. They basically made first contact 2005. 2009, we went to see them in the States. We had the kind of chat. And he made those, whatever they say, like, we'd really like to get to know you closely, or whatever it was that he said. And I was like, okay, I know what that means. So they made an approach to us. We had also another approach at the same time from another company. So we basically played with both those companies, bid them off against each other. They started their due diligence at the end of August. By the beginning of 2009, September, we got our offer. Agreed the price like a week later, term sheet the very next day. So from that respect, Cisco is fantastic. They know how to run a process. It was really painless. Obviously, lots of late night phone calls about whether we accept or not, but just to give you an insight into how that process was run. And basically, we sold the business, I think it was October 2009. All the staff remained with Cisco, offices remained. I became a general manager at Cisco's security division, and it was all fantastic for a while, but eventually, we got itchy feet and decided, myself and my brother, I'm talking about, that we wanted to start another business, so we left Cisco. But that's kind of giving you the story from the beginning to the end, from the idea to the exit. In terms of things that I want to say about exits and just general lessons that I've learned from the experience, I think, it's been quite interesting for me to read this presentation, which I first sort of put together about 4 years ago, because I've now gone on to start a new business, and I've written some rules here of what I thought were the keys to success. And so obviously I went back to try and read them to see if at least I followed my own advice, which I never really do, and I think I followed most of it. But before we get to those sort of lessons, I think that, finding an exit, I don't know if I'm hitting the right kind of note here, because I know when I was doing my MBA, that's all I was thinking about was an exit. So that's why I've tried to put this presentation in that way. But people ask me a lot about exits, and I think exits are like finding love. You need to be out and about. You need to know these buyers. You need to have partnerships with them. You need to be in the community, in the environment, so that they are aware of you. They know your number. They know you by name. You need to be well groomed. That means all your departments across all your business need to be functioning well. Like, there's no point having a fantastic product with crap marketing, or great sales with terrible customer services. You need all the departments to do really well. All your kind of pieces of the machine need to be doing well. Obviously, you need the high earnings potential to attract your partner. That's kind of that's given. And unfortunately, you can't really sell yourself. Although we try to do that for a number of reasons, we try to sell ourselves. It doesn't really work like that. You've got to be in the right places at the right time, making the right sounds, and hopefully they pick up the phone or they approach you. So that's my kind of key learnings about an exit. And then lastly, I just want to run you through like my 10 rules of startups and how you build them and mistakes that you shouldn't make. When I was at Goldman Sachs, they used to tell us about their 13 kind of commandments, and people are our greatest asset, is what they used to say. And I always thought that was a joke, because I worked it out, I got paid less than the guy at McDonald's per hour because of that number of hours I was doing. And we used to call it GSBS, but actually they were right, because people are the greatest, the biggest asset that you have. And my personal piece of advice is, for example, some of you will have businesses and have employed people, and there's always someone that you're not quite sure about, but you know that if you fire them, you're going to have to do the work yourself, and you're supposed to be expanding, not shrinking, and so you and ah, and they're a friend of yours, and you go out for a beer with them. But I think people like that are like, second-raters. They're like cancer in your organization. You cut them. The first time you thought about cutting them, cut them. Don't think about it again. Because I know what it's like. We sit around, shall we do it? No, give them one more week. They said that there's an email there. We might be doing quite well this week. So you talk about it for hours and hours and hours. Cut them. The people not performing, cut them. Network, your friends, your contacts, I think are key. It's good that you're doing an MBA. Some of you are or have done, because that network, those contacts are key in terms of expanding your company. And it's amazing how you get a call from someone that you were at business school with, or I still use my network. I look it up, my alumni book, and I say, who's working at this particular partner that I want to reach, or if I want to expand into Singapore, I look for my Singapore alums, and I use that network just to start going. They can refer you through to some right people, and that really saves a lot of time and a lot of headache. You need to remember that you become unemployable after you do a startup. I think that's my personal view, because no one will, will put up with this kind of stuff if they're employing you. So once you make that leap, I think it's very difficult to go back. I think it's really important, certainly in the B2B space. Like I'm talking B2B, which is you're selling to corporates. In B2C, it's different. But I think it's really important that you create like a general great story about your company. I can't really put my finger on it, what that means, but you need people. Companies have reputations. There's that companies in our sphere, in our space, where we would kind of turn our nose up at them, saying, "Oh, they're a bit, they're a bit sharp around corners, or they're not very that honest, or they're not really that innovative, or they're a bit sort of unprofessional." Each company's got its reputation. It's important when you're building your reputation, you create that good story about yourself. So, all your products, all your documents go out without typos. Everything looks correct. Everything's the right branding. Everything's you have the very best people representing your business. And so all of that stuff matters. It builds up a reputation, I think, for a business, and creating that good story is important. We had a great reputation in our little piece of the market, and that was really important for the eventual exit. I think it's important to raise a lot of money, and it's better to overspend than underspend, and you need plenty of cushion because things take a long time. But don't bend over backwards for VCs. They need you probably more than you need them. That's obviously a huge generalization, but I think great companies with great ideas, you should hold out for what you really think you believe in, and don't just settle for second best and raise half the money and then fail because you didn't have the right capital behind you. Better not to have started in the first place. Choose your VCs and your angels very carefully. Never give bank guarantees. I think partnerships is sort of some area that people don't talk about a lot. We, in our business, in order to sell our services to those corporates, used to work through partners, and they would represent our services, like AT&T. They would represent our services to their customer base. And I think those partnerships are really tricky. Like if you find the right partner, they can really accelerate your business and make you reach companies in Japan, get revenues out of Japan that you would never ever be able to do by yourself, or certainly not for like years and years and years. But they're also a double-edged sword. So for example, this company Postini that was bought by Google was one of our good partners. When they got bought by Google, everyone assumed that we would get also bought by Google, which I assumed myself. But then it turns out Google weren't interested. But what does that mean? It means that no one else wants to partner with you. So our partnership discussions with Microsoft fell apart because they're like, "Oh, Google going to buy you because you're partners with them now." And our partnership discussions with a bunch of other big tech firms all kind of came to nothing because everyone immediately assumed Google was going to buy us. And the reality was they weren't going to buy us, and they weren't going to invest in this relationship. So partnerships are really kind of tricky little things that you need to kind of navigate through. I think talking as a tech business, you have to be in the US. Most of those businesses have to be in the US, and don't be afraid of the US. It has its own challenges, and that deserves another kind of whole lecture about how to break the US. At INSEAD, they told us that it would take twice as long in the entrepreneurship class, which I took, take twice as long, and it will cost twice as much as you think. My personal view is that it takes like 10 times as long as you think it's going to take, and it's going to cost you 10 times as much. So I think they got it wrong. And I think you need to be flexible. You need to, I think once you're in a market, so often, like today, I'll give you an example today. Today we're looking for a PR firm, and I call a guy that I did some PR for me 2004. He's still around. I've got him on LinkedIn. You need to be having lots of conversations with lots of different people, kind of handing out loads of business cards, because those things, they don't immediately come to fruition, but 2 years later you get a call. "Hey, I met you are you still doing that thing that you did? Because now we need it." Today, I just come out of meeting my boss, and he says he needs exactly that thing that you told me you did 2 years ago and I wasn't interested in. So you need to do that stuff and be around for a long time, and then those things come to fruition. Lastly, as I kind of mentioned before, never, ever, ever give up. That's like my main message to you. Stick in there, hang in there, and if you work hard enough and you're not a complete idiot, then it'll come good in the end. So that's it. That's my presentation.
Thank you very much.
Thank you.
Okay, well, we're going to take questions for Eldar now, and the deal is you've got to speak into a microphone if you want to ask a question. So who would like to go first? Right back here, yeah.
Hi. Hello. Hi. Thanks for the nice presentation. It's really helpful. My name is dismal. I'm from the same field of the IT in the product development. Quick question about the second product, the Scansafe. Do you think that the Scansafe only born because of the failure of the first product, or second is you had money from the JP Morgan?
Do I think it was successful because of the failure of the first one and because we had money? I think that the failure of our first business wasn't really a failure. You can call it a failure because it doesn't have a nice, sexy, chart of growth. But we learned so much. We learned about recruitment. We learned about firing. We learned about marketing. We learned about cost-effective marketing. We learned about how to judge if someone's bullshitting you in sales and someone's a good salesperson. We learned how to strike good office lease deal that allows us flexibility to move when we expand. We learned so much, just little things along the way, and then you learn that in business. So I don't think we would have been as successful in the second part of our career or of the growth of that business without the learnings from the first part. So I certainly don't see them as two halves. I see them as one connected kind of story. I'm not quite sure. We didn't really have any money because we were down to kind of the last few £100,000 of pounds. But I think especially today, especially in the technology world, the barriers to entry are so low that you can get so far now with such little money that you don't really need to do these huge raises of like $20 million just to get anywhere. I mean, those days are gone. When we were doing Scansafe, we needed to invest in a lot of capex servers and data centers. It was expensive stuff. So I think these days the game has changed a little bit, but that means that obviously you get a lot more companies who are startups, so the competition's much harder, whereas back then it was more difficult to start a company. But I don't know if that answers it exactly, but I think there's so many different factors that affect your success, and you have to be in the right place. I think what this shows me is you've got to be in the right place at the right time, and with the right product and the right team.
Great answer. Thank you very much. Another question? Down here, hand over to first. Of course, when things aren't going well, we get a case study. That's what we like.
Yeah, well, you can see things didn't go that well.
I would like to establish, when you were negotiating with the firm which was buying you, how did you negotiate? Did they have a firm price in their mind with their evaluation, or did you have a price which correlated with them? That's the first part. And also, when you mentioned about when JP wanted their money back, how on earth were they expecting, when you had an agreement in place, to just hand over the funds?
Excuse me. So second part first. JP, how did they expect? They expect. It doesn't cost them money to expect. They come and they say, we expect. You tell them they don't expect. They say, we're looking at the numbers and your numbers are not the plan and we're very concerned and we're this and we're that and the board meeting and our board, and then, they wanted their money. And so if you want to know specifics, they said their assertion was that we were, I'm trying to think of the correct legal terminology, we were discriminating against minority shareholders, or we were disadvantaging minority shareholders because myself and my brother were the majority shareholders and they're the minority. This is JP Morgan Chase we're talking about. They're the minority, they've only got 24% or 29%, whatever it was, and we're enriching ourselves on the back of them. And we're like getting paid, 20 grand a year or something. So it's all complete bollocks. But, excuse me, but, it was obviously they were trying to get the cash. And so they were trying to put the moves on, put the squeeze on. They got corporate lawyers and legal advice and barristers and blah, blah, blah. But obviously, fundamentally, they didn't have a case and they didn't really want to push it. And it wasn't very good for their reputation to kind of kibosh another firm. They were just hoping that we would say, fine, give us 100K and take the rest of it and off we go on to the next thing. That's what they were hoping, but it didn't happen for them. Second thing about the negotiation, Cisco started, if I remember correctly, at 40 million.
Really enjoyed it. Would love to have been a fly on the wall when you told your ex-investors how much they could have made. My question is about your product. How good was your product versus your competitor's product, and how much influence did that have in terms of you getting sales? Was it were you just fabulous at selling and marketing, or were you just superior as a product itself?
We were unique. We were delivering the same protection that other people were delivering, but we were delivering it as a service or in the cloud, software as a service, on demand, inline. There's 20 different ways of saying the same thing, but basically we were the first company to deliver web security as a service. So no software, no hardware, no maintenance. Now everything is delivered on demand, they call it, or in the cloud, or ASP. There's 20 different ways of saying the same thing, but back then in 2004, cloud services were very rare. We had already been doing it since 1999. Now it's like, that's obviously the future of computing, but we were doing it since 1999. We were delivering those advertising services as a service. So we never had any software on the desktop or any hardware or appliances. We were always delivering everything as a service, and that was really the kind of crucial thing that we did. And by doing that, we could offer better protection, we could offer it cheaper, we could do it without maintenance, we could support thousands of customers without field sales force or without field engineers, which these big companies had. So that was really the unique part of what we did. Initially, our product was terrible, but it was different and it was unique. And so obviously then as the money started coming in, as we raised money, we started building out the product, the feature set, the marketing behind it, the support behind it, the 24/7 round-the-clock support, the multiple data centers, the redundancy, the failover. You just add and add and add until our service was better than everyone else. But initially it was based on the fact that we were delivering it as a service.
Very good.
Well, not to get into the top quadrant, because some people actually, when you're small, making it in the bottom quadrant is a big news
Getting on
item.
any quadrant's good.
Or any,
And
yeah.
I have to tell you that we, so at Scansafe we were cool vendor, then we were visionary, then we were challenger, then we were leader. And literally every year we went cool vendor, next year we were visionary, next year we were challenger, last year we were leader, and then we sold. And my new company, Wandera, we just found out that we were going to be a cool vendor for a new quadrant. So for our new business, which is interesting because, they've heard about us. And obviously, it's a two-way thing. They also need some cool new companies. They can't keep talking about the same old companies all the time. So you need to get on their radar somehow, somewhere, at a conference, at a trade show, through a contact, through some PR, through the Wall Street Journal, whatever means you have of getting onto their radar. And obviously, fundamentally though, there's a lot of that stuff that you can do, marketing and spin and positioning and this, but cold hard like it's customers. So when they get a call from GE saying, hey, I bought Wandera, that says Wandera's on the map, or Scansafe's on the map. And that's really what it comes down to. Finally, at the end of the day, it comes down to your customers, because we can all spin and we can all message and we can all lunch and wine and dine them, but finally it comes down to your customer numbers. And that's what it comes down to, I think, with an exit as well. So Cisco, for example, started really taking an interest in us when their sales guys were losing deals to us. They were like, their sales guys go to their bosses, hey, I lost my commission this month because my big prospect, GE, didn't buy my stuff. They bought some piddly company called Scansafe. Who are these guys? And then that happens 3 or 4 times. The manager starts to lose commission too, and that goes up the chain till they say, hey, we need to buy something because we're losing. So they go to Corp Dev. Do you have any security companies you can buy? And that's how it really, it's a bit of an exaggeration, but basically that's how it happens.
Interesting. Yeah. We have a question over here, Mark.
Thanks for the talk. I have a more personal question. When you were starting up and we saw those revenues curves were kind of like dangling around, your brother had been in PE, you had worked in Goldman Sachs, you had done an MBA, you had some pretty good expectations of what life was going to be as a dot-com millionaire. What kept you persevering at that point? What kept you wanting to keep on going day after day?
I made a reference to it here, so I don't know if they teach you this here, but I remember from my MBA, they told this analogy of cooking the frog. Do you know what I'm talking about? So boiling the frog, and so if you'd have told me in 2004, I've got this great opportunity for you to be CEO of a company with $500,000 of revenues, I'd be like, what, are you kidding me? It's like that was my salary before. Never going to do that. But if you're there for 4 years, you're grinding it out, you're hustling, you've got team, you've got camaraderie, you've been through ups, you've been through downs, you've got optimism, I think, eventually. We kept at it. I mean, there were lots of times when my brother said, I'm going to leave, and I said, no, I'm going to leave first, you stay. And there's lots of that. My dad, actually, to tell you the truth, if you want to know the real answer, is like my dad, we were both going to throw in the towel, and he said, no, because he was always an entrepreneur, and he said, you've got to stick at it, you've got to keep going. And I didn't want to disappoint him, so I kept going. But there was always something there. We didn't think it was like complete basket case. I'm not suggesting for 1 minute, if your business is complete rubbish, to keep, what's the phrase? Something, flogging a dead horse, exactly. You have to have some, but you could see we were selling something, right? We just had limited resources, and we were doing something. And this is like 4 or 5 different business models. So it wasn't complete dead loss. And also it's to do with your alternatives. If your friend from your MBA course comes and says, hey, I'd like you to come and run a hedge fund with me, then you're like out of there. But if you've got no alternatives, then you keep going.
Hi, I wanted to ask a question that's sort of a follow-on from that. How do you decide at what point you're going to exit, as opposed to see how far you can take it? Is it that you hit a threshold, or you want to do something new? Or?
Yeah, that's also a great question. I'll preface my answer by saying that we recently had a discussion with someone who does a lot of tech exits for Morgan Stanley in the Valley, who we knew from back then, and who told us that if we were around today, we'd be worth $1 billion. So I'm just prefacing my answer to you that, we sold 180, and we could probably, if we were still here today, be worth $1 billion. But do I regret it? No. And I'll tell you why. Because after this story, after this 10 years, and like every year you're doubling down, every year all my net worth is in these shares that I've got of a company that could, and you wake up and you get an email from your guys in the States, and they're like, Microsoft are launching something. You're like, oh my God, Microsoft, they're going to kill us. They're going to bundle it in with the browser. We're dead. We're finished. It's good. We've got to sell tomorrow. Otherwise, and then you realize that actually, Microsoft can't develop their way out of a paper bag. And these guys, they're going to do it. They can't do it. And actually, you're good at what you do, and you're there. So how do you decide when to sell? I think it's a dynamic of the situation. We were worried about our marketplace. We were worried about people bundling in our services to them. We were the first, someone asked why we were successful. We were the first to deliver web security as a service, but we spawned like 7 different competitors by the time we sold, and they were all starting to nibble at us, and we had 40% market share by then, but we were used to having 100% market share, so it was a bit of come down to 40, and so the dynamics are changing. That if you don't sell to Cisco, then they're going to start something and bundle it in with their router. And then who are you going to sell to? Because Microsoft aren't buying you because they're worried about Google, and Google said no. And so then you're like, where are we going to go? Are we going to IPO this thing? And oh, I want out. I want to go and sit on the beach. And so there's a number of different dynamics, And so no one pressured us, but we kind of got to the stage where we felt like now's the time, and the dynamics are right. We're going to get a good valuation. I've had enough. I want to take some money off the table. I can't keep letting it ride on the next horse. But my view's changed now in the next one. But that's
when you're going to go all the way, huh?
I want to, yeah, because, you know, I don't have that dynamic, and I actually realized that once you sell, you know, the big problem is what do you do next? You know, so I'd rather just keep going. And
It's going to be a lifestyle high growth tech.
yeah, but I mean, that's my view on it, and everyone's different. I respect everyone for doing whatever they want to do, but for me, personally, of course, if someone comes and does make some stupid offer, you're very tempted. And it's just affirmation that you're doing something right. That's the other kind of attractive thing about it. If someone, Google calls you up, says, we're offering you XXX million, then you're like, oh, that's great. That's, you know, it makes you feel good. But really, what you do is you wake up the next day and you don't have that business, you don't have that challenge. If you're someone like me who's interested in business, likes to build things, I love going to trade show and meeting old customers, and like my staff are there and we're talking about our new deal and the fact that Japanese telecom just called us up and they really want to, you know, I like that. I like negotiate. No, tell them no, they can't have it for less than 40%. You know, I like that stuff. And planning our PR campaign and getting into Gartner. So if you like that and you sell, what have you got? You've got some money in the bank, but then you're like, oh, wonder what new business idea I'm going to have. Oh, I'll do instant messaging. Oh no, WhatsApp. I'm going to do this. Oh no, there's king.com. You know, then you're like back to square one. So for me, I enjoy the ride. And that maybe is easy for me to say because I've sold the business for a lot of money, but that's where I am now.
This is a very neat way, we're slightly over time, very neat way to end. Start off thinking you're maniacal. And that got you a lot of money.
Yeah.
The second time around, you're going to be a bit less maniacal.
Correct.
Yeah. Thank you very much, Eldar.
Thank you.